Okay, hey there guys, how's it going? Hope you are well. Welcome to this video. So, some slight changes from episode number 1. If you watched episode number 1 of this series, you would have seen us go through the process of analysing AA PLC. We went through all the financials and we used the process that I use to deduce whether or not a company can make it into my watch list and ultimately be invested in, or if they fall by the wayside. And the vast majority of them do not pass. They do not qualify. Only a small select handful actually make it through into my portfolio, and AA failed. And what I've done since doing episode number 1 is I started to create a scoring system. So what I've done in this episode is I have worked out and created a sort of algorithmic score that kind of goes with the results of what we've found in the financials. And so what I've done is I've gone through all the different kind of parameters that I look for and what constitutes a pass or a fail within a business, within their financial results. And I've attributed scores to certain types of results and tiered results and stuff like that. And I've essentially built an algorithm that once all the results are in, I can push through my scoring system and I can attribute a score to those results, basically, to that company. And what I thought would be cool is if we did a leaderboard. So every week we will be going through a company and looking at the results and deducing whether or not they would make it onto the watch list or not. But at the very end of that as well is we'll be attributing the company's score and adding them onto the leaderboard, so we can have a bit more comparison between the companies, so we can see which companies are performing better than others. I just thought it'd be a bit of fun, bit of something a bit different. Never done anything like this before. It might be a complete flop. It might be enjoyable. Who knows? So I've done AA already because we did AA in episode number 1. AA scored -46. So that's how bad things were with AA PLC. Carrying huge amounts of debt, that company, and the results are not looking good with AA. Not necessarily in any trouble, although they may be in the future, certainly with that level of debt that they carry, but certainly not anywhere near a company that would qualify for my watch list, for my portfolio, and a company that I would never be invested in. So to give you a bit of perspective, I suppose, most companies that pass and make it onto my watch list, you can expect scores of about 100 plus. So AA are a -46 to start us off with. Not good. So let's dive in. Let's go into another company and see how they perform. Okay, so today, I'm just not my microphone. Today, we are going to look at the FTSE 250 company Tate and Lyle, sugar manufacturers and distributors. We've all probably heard of them. Again, another household name, Epic code TATE, Tate. We're going to look at them today, and we're going to put them through exactly the same process as we put AA through, and the same process I put all my companies through that qualify for the watch list. And we're going to see whether or not Tate and Lyle pass the test, and if they do or they don't. And then we're also going to attribute the score to them, and we'll add them to our awesome new leaderboard. So let's dive into the numbers and start crunching and seeing how they performed. Okay, so first of all, what we will notice here is the revenue. Revenue is the first thing I generally look at when I look at a company here. We've got 10 years worth of annual reports, actually 11 years worth of annual reports going from 2009 to 2019. You'll notice that it's gone down from where they were in 2009. They were a 3.5 billion company in 2009, now only 2.7 billion revenue coming in every year. So that's gone down. And what we'll also notice is that in the last 3 years, it's basically been stuck at 2.7 billion. It's not really going up. It's not really going anywhere. And something that's quite indicative of these clean watch list companies, these companies that make it onto my portfolio, is that they're all growing. The revenue is going up every single year. There's more money to be made out there in the industry that they work within, and they're managing to find it. Tate and Lyle are not doing so. They're not able to grow the business. They've gone down, if anything. So that's a bad sign to start with. It's not terrible. Doesn't mean it's, they can't possibly qualify, but it's a bad sign to start us off with, unfortunately. Then we can look at gross margin. So margin is the slice of the cake that they are left with at this early stage, and that's very low. The margin's very low right now at sort of sub 10%. Certainly the last 5 years we've been looking at around an average of maybe 7-8%. So that's not good. That's a very, very small slice. Again, it doesn't wipe them off as a failure in itself, but it's again as a poor sign. It basically means that revenue, the money coming into the business, isn't that strong, but the cost of sales is obviously increasing, and we can kind of see that 2.3 billion, 2.2 billion, then up to 2.5 billion, and we're kind of stuck at about 2.5 billion. So it basically means that revenue is not strong, and the cost of doing business, the cost of sales, is either flat or is going up, and it's therefore resulting in the company having a smaller slice of the pie, so to speak, as they progress. And certainly that's the pattern over the last 5 years. We've seen not a great slice, if you're at a party and you're getting that slice of birthday cake, you're not pretty happy, you're getting a very thin slice there. We come all the way down to interest on debt. Interest on debt is all over the place, very up and down. We've got some very high figures here, but that was largely attributed, these large percentages largely attributed to the lack of operating profit that year. Therefore, the percentage of interest on debt looks awful. But as you can see, in relation to the previous years and the following years, not a lot of difference. So that percentage is probably squiffed, or it doesn't really give us a true reflection of what's actually going on. Interest on debt is okay. It's slightly on the upper side, but it's all right. And it's costing them about 10% to 15% of the gross profit, which is it's all right. It's a bit high, but then the next place we'll go straight into is the net earnings. So this is this figure down here. This is the net earnings of the company. So after all the expenses and all the costs taken out, what are they left with at the end? So when we're talking about a slice of cake, at the very beginning, when we look at gross margin, that's a slice of the cake they get at the very beginning of the process. But what is the slice of cake that these guys are getting after all their costs have been taken out of the process? All their expenses and things like that, and interest being paid on debt and taxes and all this kind of stuff. What's the very final slice of cake that they're getting? And it's quite low, unfortunately. It's not terrible. This is a profitable business for sure. Tate and Lyle are definitely making profit. They've had a couple of losing years, 2010, 2015. However, what we'll notice in those losing years is that, let's go to 2010, they recorded a profit of 19 million, but my numbers show a loss of 21 million. That's because of extraneous income that was nothing to do with their recurring business that came in at 40 million, so it skewed the figures a little bit. So it made them look better than they were. And actually what they should have been posting if we were just looking at the recurring business is a minus £21 million loss. And in 2015, we see a similar sort of story here. They posted a £30 million profit that year, which was bad for them anyway. But they actually sold off something for 49 million, which was not part of their recurring business, and as a result, they should have really been looking at the recurring business of Tate and Lyle would have made a 19 million pound loss that year. So a couple of losing years there, never good. We never like to see losing years. That's going to really hamper share price growth for sure. Investors do not like investing in companies that are losing money. But yeah, we've got definitely a profitable company. We're talking about hundreds of millions in profit here. Unfortunately, the percentage of that against what's coming in, i.e. we're talking about 2.7 billion revenue business here, and they're only keeping, as of 2019, they're keeping 150 million of that. It's a very small slice. It's a 5% slice of what's coming into the business. It's profit, but it's quite a thin margin, and so again, that's not great. It's not really what we're looking for in a clean watch list company. But I've got a feeling already Tate and Lyle are probably going to score higher than AA looking at this. But we'll see how far they go. In terms of a clean watch list company, these guys are not going to make it onto the watch list, but it'd be interesting to see what their score is by the end. So Assets against liabilities. The company have a relatively healthy number of current assets against current liabilities. That number is pretty solid. It's not great. It's not amazing. It's not blow your mind sort of amazing, but they're doing okay here. When we come down to the long-term debts, you can see these long-term debts here of this company. So they have 1.1 billion in borrowings back in, when was that, 2009. Today that's only 373 million. So there's obviously been a conscious effort to reduce the amount of debt this company owes. And back in 2009, based on the amount of money that Tate and Lyle were earning, their long-term debts would have gave us a kind of a long-term debt ratio of 12.0. What that essentially means is that it's going to take roughly about 12 years for that company, based on their actual income and what they're making, to pay off that debt. It gives you an indication of, right, what's the size of the debt, what's the amount of money coming into the business, how long therefore would it take in theory for them to pay that debt off. And we've got some skewed figures here as well, because obviously the next year they made a loss that year, so it makes the whole ratio look awful because they weren't making any money. So how are they going to pay off the debt, right? But when they get back into the flow of things, we're looking at certainly the last 3 years, we're looking at about 2.5 years to pay off the outstanding debt right now. That's well within the limits that I'm looking for. That's absolutely fine. If we've got a company with a long-standing amount of debt, that based on the performance and the ability of that company in terms of their earnings would be able to pay that off in 2.5 years, that's totally fine with me. That's a good, healthy figure. That means that they're borrowing within their means now, something they weren't doing before but they're starting to do now, so that's good. And then I want to come down to retained earnings. So this is basically a pot of money that they're just throwing more and more money into in theory, and that can be used for special dividends. It could be used for acquiring other businesses. It could be used for investing in assets and buying property, buying plant and machinery, that sort of thing. Anything like that. It's always good for a company to be sitting on a pot of money, right? Even on a rainy day, it's good to have that money behind you. Tate and Lyle have done all right with this. They've not been consistent in growing it. They've dipped in a few times. They dipped in 2010. They dipped in 2013. They dipped in 2015. So by dipped in, I mean they've taken a chunk of that out and used it. And most of that time, most of those occasions were because they had bad years, and so they've had to dip into it. But they've consistently managed to grow the retained earnings, so that goes in their favour. Back in 2009, they had 241 million. They now have 741 million that they're sitting on. That's pretty healthy figure there. The return on shareholder equity, not very strong. Again, up and down all over the place. It's okay. It's kind of middle of the road, kind of average. Essentially, the return on shareholder equity score basically gives us an indication of what kind of return is the business getting on the assets and the equity that they own. Basically, what kind of return are they getting back off that? Because in theory, if companies are buying assets, i.e. they're buying property, they're buying machinery, they're buying plant, they're buying intangible assets, if they're buying these assets for the business, you would expect them to be those assets to be putting money into the business's pocket and producing some sort of an income. And so we can measure that based on looking at what return is the business getting on the assets that it's investing in. And the scores, they're okay. They're all right. They've had a few good spells and some bad years as well. Right now, it's of 2019 is at 10%, which isn't very good. It's okay. Basically, it's kind of average. And then one of the big concerns I've got with Tate and Lyle is their expenditure on their capital expenditure, or their capex, as people like to call it. But essentially, what are they spending on property, plant and equipment and intangible assets? And are they spending above their means? And on this occasion, it looks like they are. They're spending about 91.9% of their net earnings is spent on capital expenditure, which means they're spending a hell of a lot of money on property, plant and equipment, and we're not seeing that reflected in the returns, the income coming in. If they're buying a lot of this stuff, then we would expect to see some really big earnings coming in if they're investing that money well, if they're buying the right sorts of assets, and it just doesn't give us that indication right now. And so they failed the test overall in terms of these guys are not a clean watch list company. They will not be coming into the clean watch list at all. They are not an unprofitable business. They're clearly making money. But when you look at the hundreds of companies that are available on the FTSE to invest in, that basically the bottom line is there are far better companies to be investing in than Tate and Lyle for me, and so as a result of that, they don't make the grade. Let's have a look at their charts, their share price chart, to see how these numbers are reflected in what the share price has done over the last 10 years. Always interesting and useful to have a look into. Okay, so we're only really interested in the last 10 years or so since we've been doing those reports to give us an accurate reflection. Things have they've done all right. You know, it looks like we started off 2009 at about £4 a share, now at £7 a share. It's been pretty dull, really, since 2012. I mean, since 2012, nothing has really happened. We've not really gone anywhere in terms of share price. We were sitting up at £7.25 in December 2011. We're now coming into December 2019 and we're still there. So that's 8 years of just nothing, right? Obviously it's gone up and down over this time, but it is essentially 8 years of nothing. And that, therefore, I mean, this is why I always see the financial results that I look for, the specific results I'm looking for, give me a very good indication as to whether these companies should be invested in. And I always see so far in the hundreds of companies that I've looked at, share price growth off the back of the companies that are doing what I'm looking for. In other words, and trying to explain that in a different way, if the parameters that I'm looking for are met, what I generally see 99% of the time is rising share prices. That's generally the results that I get from all the parameters being hit. And I look at the parameters first, then I look at the charts and I can see, yeah, the charts are huge. You know, the charts are doing really, really well. And there's a reason for that. It's because they're doing everything right from a financial perspective. And when you look at Tate and Lyle, they're not doing everything right. They're not meeting all the parameters. They're not, you know, smashing it as some of the portfolio companies are doing. You can see it reflected in the share price. The share price is just really going nowhere. It's been the same for the last 8 years. So, yeah, again, it's just you'll see this as the series progresses, and we look at these companies, and we look at some companies we'll look at that will pass the test, and they will be a clean watch list company, and they will score highly on the board, and you'll see their share price has been flying. And there's definitely, in my experience now, with all the research and the testing that I've done, a definite direct correlation between the parameters that I'm looking for from a financial perspective, through my mining and my analysis, and share price growth. And it doesn't always happen straight away. You know, if a company starts performing really well in, let's say, 2010, sometimes it can take till 2012 before the share price starts to fly, but it generally flies at some point. And so, you know, you'll see this as the series progresses and we do more and more of these. But yeah, so again, there is insight into what the share price has actually been doing. Not a company I'd want to invest in, because I don't want to be waiting 8 years for a share price to stay at the same price. I mean, sure, we haven't lost any money, but if I'm going to tie up my money for 8 years, I certainly want a return over those 8 years, right? So I'm not interested in Tate and Lyle from a financial perspective, but their share price is just another layer of confirmation of my belief system, I suppose, and my results and my analysis and what I've done. So to wrap things up then, the big reveal. So how did Tate and Lyle do? Now, in proper Top Gear fashion, I've got these little white little things here that I'm going to stick up on here, and I've not prepared for it in typical Chris style, because I really should have put some of these sticky labels on. So I'm going to do that very quickly and pause this video whilst I do that. Okay, we're back. So I'm now prepared. So here we go, the big reveal. So I've basically run the company's results through my scoring process, my kind of little algorithm. Got this little piece of paper here that's going to be going on the leaderboard. Rip this off from Top Gear, absolutely. Not a massive Top Gear fan myself, but I remember seeing episodes and thinking, you know, that's quite a cool little idea to do for this process. So we've got Tate and Lyle. Tate is the epic score, and their results. Let me just bring these up to remind myself, make sure I don't mess this up. Okay, Here we go. So, Tate and Lyle score a whopping 10 points, which puts them above AA. So we can take AA off and knock them down a peg. And put Tate and Lyle in pride of place. And there we go. Tate and Lyle obviously doing better than AA. In terms of my analysis, Tate and Lyle are the better company. But again, let me give you some perspective on this. I'm expecting clean watch list companies to score over 100 points. So even then, Tate and Lyle are still miles away from getting to where we want, in terms of the quality of the company that I want to invest in. So it'll be interesting to see where this goes. And I expect these companies to be pretty low down at the bottom by the time we've gone through a few more of these episodes. In terms of selection of these stocks, at the moment I'm doing them at random essentially. So I'm just picking companies and I'm running through the analysis of them. Companies that I may not have already looked at. Some companies I have looked at, which saves me a little bit of time. If there's a particular company you're interested in finding more out about, maybe you're interested in investing in them and you want to know how they perform in this particular criteria, then leave a comment underneath the video. Give me a shout on there maybe, or hit me up on Facebook or whatever you want. Maybe even throw me an email across. You are more than welcome to do so, and if I've got time and I can get it in, I'll do some of these, and we'll get them up on the leaderboard and we'll have a look at the results and I'll share them with you in future episodes. But otherwise, Tate and Lyle, better company than AA, but not a clean watch list company. Did not pass the criteria for me, but obviously have topped the leaderboard this week. So thank you very much for watching. Hope you found it entertaining and useful, and I'll see you in the next episode. Cheers guys.